Ladies and gentlemen, let me welcome you to today's podcast. My name is Subodh Mishra. I am a Director of Communications here at Institutional Shareholder Services. I'm very pleased to be joined by my colleague and ISS Special Counsel, Pat McGurn. Pat will be talking today about how to sort of understand the current pandemic crisis in the context of what has happened in the past, whether that's been the dot-com bubble bursting or the global financial crisis of 2008, of course. And so, Pat, I know that this year marks your 25th proxy season here at ISS. And so I can really think of no one better to ask the question of what lessons you've learned from past crises and what sort of insights can you provide to give our listeners a sense of the current pandemic.
Yeah, it's great to be with you today, Subodh, albeit long distance, obviously. It's closer to 35 seasons overall for me in the proxy advisory business. If you include my time at RSC, so yes, you've just run through a couple of them. I've been through a lot of market shocks, crashes, downturns, recession scandals. That includes a long list. Black Monday back in October of '87, the recession of the early '90s, the bursting of the dot-com bubble at the turn of the century, then September 11th, the Enron and WorldCom scandal-fueled downturn in 2002. And then, as you mentioned, the financial crisis in 2008 and 9, I think, that caused the Great Recession, and then now the COVID-19 pandemic. But looking back on these events, there are a lot of common threads that carry forward to today. But I'd have to say that the current situation is fairly unique, both in terms of scope and causation.
How is that, Pat?
Well, I think there's actually three main areas of differentiation. First, most of the previous market meltdowns were more limited in scope or duration, and many of them were primarily driven by structural problems in certain sectors, so they were more or less local, I think, in the economy quite often. The bursting of the dot-com bubble, for example, was hardest on newly public firms in the technology space. The financial crisis started with banks and then spread to other financial institutions and then over to other sectors given the broad liquidity and credit concerns. But in sharp contrast, the current problems related to the pandemic arose very quickly, and the impacts have been market-wide, albeit fairly uneven, I think, between sectors, but also very much global in reach. Due to travel restrictions, stay-in-place orders, and complete market lockdowns, some sectors like airlines, retail, restaurants, hotels have been really heavily impacted, more than even in previous crises. But other sectors like oil and gas have suffered from the fallout as well due to the lack of global economic activity and demand. Second, the widespread loss of investor confidence in public markets helped to fuel the downturns, for example, in the wake of the Enron and WorldCom failures, and deepen problems like those following the financial crisis. With the pandemic, obviously, the problem is not fraud, misconduct, financial engineering, excessive risk-taking, or even deeply flawed dot-com business models. The problem here is uncertainty caused by a very unpredictable virus. And in fact, for many businesses, the real enemy now is time. Literally, the questions asked in boardroom: how long will this first wave of this pandemic last? Will there be successive waves? How long will all of these waves last cumulatively? And how soon will we see a vaccine or other treatments come in to respond to the crisis? As a result, for a broad swath of the market, the near-term goal is, to put it bluntly, to simply have a long-term goal. In other words, the focus is now on survival. And then finally, and you referred to this before, many past crises had deep roots in poor governance practices. Dot-com boards were woefully unprepared to deal with that market downturn. It was literally the emperor's new economy, and for most boards in that realm, there was no plan B other than B for bankruptcy, of course. And then in quick succession, the Enron scandal showed that weak boards were not limited to Silicon Valley. Many directors had become literally lapdogs for management teams, and some trusted watchdogs like auditors and analysts simply didn't bark, and And looking at the regulators, well, I guess you could say they didn't. I think, and similarly, the absence of strong board oversight with respect to risk-taking both contributed to and exacerbated the financial crisis. Now, today, in contrast, most boards appear to be dealing with the pandemic in a highly thoughtful fashion. Luckily, we haven't seen a great deal of knee-jerk activity by boards so far, and this newfound thoughtfulness appears to apply to investors as well. And that also represents a big change from the past. The growth of permanent capital, the rise of stewardship codes, and the use of engagement provides hope that the recovery from this situation isn't the usual vicious cycle of fear, greed, fear, greed, fear, grieve, and even some of the activist hedge funds appear to be taking, for now at least, the long-term view.
That is very interesting, and it sounds like we're in uncharted waters to some degree. And so, just to seize on something, Pat, you mentioned boards a couple of times already, and so, really based on the past crises, what are some of the biggest challenges that directors, I suppose, will face in the wake of the pandemic, and certainly its impact on the global economy?
Well, job number one today for boards is helping management teams deal with the crisis. While the pandemic is probably the worst-case scenario drawn from the crisis management exercises that boards have been doing since the financial crisis, directors' sharper focus on the risk oversight appears to be paying off this time around. I think boardroom exercises that force boards to literally consider hypothetical black swan scenarios on a regular basis may actually account for the dearth of sort of panic-driven action so far in the wake of the pandemic. And I'm happy to say that from the board members who I've encountered, at least over the last month, the common messages that I've heard are compassion, concern, confidence. I think that they can deal with this crisis and come out on the other end. I think directors have literally been going nonstop on many boards over the last few weeks as shutdowns, lockdowns, and quarantines spread along with their businesses across the globe. And the goal has been for these boards is really to bolster the resilience of their operations in hopes of ensuring successful relaunches when the virus finally retreats. And I really have seen limited signs of panic or overreaction in boardrooms, and that's good news for investors and for the folks, the other stakeholders of those firms.
Yeah, good news indeed, and certainly that's very good to hear. I mean, do you have any concerns related to boards? I guess in general, I suppose, in light of the pandemic.
Yeah, I mean, looking back, I do have a few concerns, but the good news is I think we can learn lessons from those past crises and avoid repeating some of the same mistakes. Just one thing that currently crops up or constantly crops up is that history shows that boards tend to want to circle the wagons during times of crisis. If you think of it, it's just human nature. You want to surround yourself with allies, team members, trusted associates, friends. And so while social distancing obviously makes this forming of ranks a little more difficult now, boards clearly have tightened their circles. And there are some potential problems that can occur when boards turn inward. When we look back a couple of years ago at boardrooms during the Great Recession, there was almost zero turnover in those board memberships. In fact, boards often waive normal retirement rules to keep experienced directors in the boardroom over the course of the market's recovery and beyond, and in some cases well beyond. Such continuity clearly helps some boards to deal with near-term challenges, but it also stopped boards from refreshing their ranks and adding new skill sets to address the sort of the continuous group of concerns that are emerging just in general business today. And over the past few years, this boardroom logjam finally broke as investors began prodding boards to increase gender diversity and update skill sets in the boardroom to deal with issues like cybersecurity and human capital management. But the result of this kind of stop and start process was that there have been several huge bumper crops of new nominees dominated by women candidates over the course of the last several years. And given that the remit was for fresh faces and perspectives, a significant portion of these incoming classes are comprised of first-time directors. And I think in the long run, this influx of talent and diversity will enrich boards. But for now, at least, it's also increased the likelihood that many of these neophyte directors have neither been through a crisis in their boardrooms, nor have they weathered a significant market downturn. This resulting experience gap may leave boards even more dependent on their longer-serving colleagues or cause them to lean heavily on management or outside advisors during the course of this crisis. In looking forward a little bit to avoid a repeat of this sort of feast-famine cycle in refreshment, as the market recovers, shareholders should make sure to reignite that refreshment flame to ensure a never-ending stream of new talent coming into boardrooms. Another problem is bandwidth. That's a major concern. The pandemic, if you look at it, is really the worst-case scenario for quote-unquote busy directors who serve on multiple boards. Such directors, they'll typically count on the relative stability of most of their directorships during times when an intensive focus is required at one or more of the companies where they serve as a director. Given that the pandemic impacts every company, and that includes public, private, for-profit, non-profit, as well as educational institutions, the slack normally required for these busy directors is long gone. There literally aren't enough hours in the day for those individuals to give adequate attention to their broad range of obligations. Their time will be spread thin and, unfortunately, unevenly as a result. And when the crisis subsides, hopefully some of these directors will rethink their workloads and voluntarily cut back. If they don't, it'll be interesting to hear investors' evolving views about overboarding in the postseason based upon their experiences right now.
Pat, that's a very interesting point on bandwidth, and yeah, that will be interesting to see how investors' views evolve on that issue of overboarding, as you just mentioned. You also mentioned earlier a bit about risk oversight, and if I can kind of stay on that point, I'm wondering how the pandemic will, effectively change boards' behavior in that regard.
Well, in the last decade, really following the financial crisis, I think many boards have significantly raised their game with respect to risk oversight activities. I think I'm guessing that boards that made it a priority are going to end up faring a little bit better during this crisis, and I think we'll probably see them double down their efforts going forward. Frankly, boards that didn't place such a high priority on risk oversight over the last decade are probably playing catch-up on the fly, which is difficult to do in these circumstances. One thing I think we'll see is that the current crisis could serve as a tipping point with respect to boards creating standalone risk committees or other dedicated panels. We saw those committees spread across banks in the wake of the financial crisis, but they haven't really developed significant traction elsewhere, with most other companies still putting risk on their audit committees, already packed agendas, or really making the full board responsible. I think going forward, we'll see more standalone panels, and I think that's especially true given that some boards have already formed ad hoc panels to address the pandemic. I think those may transition into standalone risk panels when the problems start to subside.
Interesting as well. And Pat, if I can maybe just to shift gears here a little bit, one thing that certainly we've been tracking is the resurgence in takeover defenses such as poison pills, the potential muting, I think, of investor voices when there is a virtual-only meeting, which, of course, makes sense in this current, crisis. But what sort of broadly speaking with regard to shareholder rights, and governance issues do you expect, will come about as a result of the pandemic? What's going to be, maybe short-term, what may be longer-term? What are your thoughts there?
Well, we're definitely seeing the usual mixed responses to stock price shocks coming into play. As you mentioned, takeover defenses, especially directors' adoption of short-term rights plans without shareholder votes, always tends to raise its head during these down market environments. The market's volatility has some boards feeling very insecure, and for good reason at this time. I think. But while some sort of breathless commentators have cited the record number of pill adoptions over the last month, for example, I think that boards and some, but maybe not all of their outside advisors, have shown a significant degree of restraint. I think we'll clearly see more pill adoptions over the next few months, but the actions will be more or less concentrated in industry sectors where stock price shocks have been more pronounced. I think a follow-up wave will, as it usually does, of pill adoptions will likely come, but with the rights plans focused on preserving the values of companies' net operating losses on a going forward basis. As you mentioned, annual meetings are undergoing significant shocks due to health concerns related to the pandemic. Virtual-only meetings have become the dominant form of interaction this spring, and the trend will likely continue throughout the summer and even into the fall. Some companies appear to be using the crisis as an opportunity to showcase how technology can actually make shareholder meetings more inclusive, but others have elected to take the bare bones approach, providing audio links, but literally no other interactivity or opportunities for shareholders' questions. I think when all of the dust settles, this year's crash course in virtual meetings will probably determine whether investors embrace this new technology or reject it for a period of time. The pandemic also may shine a spotlight on mechanisms that allow shareholders to act between normally scheduled shareholder meetings via either special meetings or written consent solicitations. Out of fear or necessity, some boards will take unilateral actions over the next several months related to capital raising or the adoption of entrenchment mechanisms such as staggered boards. Some shareholders ultimately may object to these actions, but in many cases they'll find themselves without recourse until the next AGM. Such frustration may lead to more shareholder support for shareholder resolutions and other activism campaigns asking boards to make it easier for shareholders in the future to call special meetings or to initiate consent solicitations in between regularly scheduled meetings. The current virtual meeting environment should also hasten, as we've heard some indications that they might be moving on at the SEC's actions with respect to the use of universal ballots in contested boardroom elections.
That last point is very interesting in terms of universal ballots, and certainly I think also too with respect to special meetings and written consent, potentially getting more play going forward. So let me switch gears again and talk a bit about compensation. What is going on in terms of any trends there?
Well, I'll digress. I guess I first have to start with my DTRT file. I think.
What is that?
Well, beginning back in the early 90s, I've kept an old folder of clippings about CEOs and other top executives who, quote unquote, did the right thing, hence DTRT, by cutting their own pay when they were called upon to make significant layoffs in the face of past market swoons. That dog-eared file folder has been retired, but I'm now maintaining a spreadsheet of CEOs and other senior executives and directors who have given up all or part of their salaries or other compensation in the wake of the pandemic. And it's growing. I think it started with airlines, retail, hospitality, and hotels leading the way, but such cuts have spread to other industries as well. Interestingly, the current crisis really marks the first time that such announcement have been met with as much skepticism as applause, as many sort of jeers as cheers. Reporters and some other commentators, especially on social media, are quick to switch the old pats on the back to slaps across the face now by noting that salary typically comprises a small portion of top executives' total compensation, with short-term bonuses and long-term equity grants providing the lion's share. So I guess it's just a sign of our times that sometimes doing the right thing is not even going to register with all the negativity out in the marketplace at this point.
Yeah, no, I see that point. But what about the bonuses, the stock-based awards? What are you seeing in that regard?
Well, simply put, timing is everything. I think for some companies, the timing of the crisis literally could not have been worse, since many boards had just set the terms of their annual awards earlier in the first quarter. As a result, many of these both short-term and long-term awards were made clearly without full visibility in the then unfurling pandemic. Now many boards will need to go back to the drawing board in efforts to appease CEOs or other senior executives who may feel stuck with lottery tickets that literally are very unlikely to pay off at this point in time. This balancing act may prove to be next to impossible, though, as boards face potential backlash from any changes from rank-and-file employees, the media, and investors. Other firms, on the other hand, who are on the cusp of making grants or setting grants, are now, in many instances, between a rock and a hard place. If they're usually being asked to deliver dollar-denominated target awards at reduced stock valuation levels, this will raise significant concerns about both burn rates and undue enrichment, I think, if the market rebounds quickly. As a result, some boards may elect to defer grants, provide other types of compensation as a bridge. Beyond the short-term adjustments, we'll see the what I call the reemergence, if you would, of the three remuneration R's of any recession. That is, resetting goals, rethinking metrics, and replacing the old repricing of underwater options. Looking at resetting goals, expectations for a slowdown in economic growth were already being considered in many boardrooms prior to the pandemic, so sideways or downward adjustments were becoming more prevalent. But I think in the current environment, strong companies may be buoyed by their relative performance metrics, especially those driven by TSR, I think. But boards at weaker firms may fall back on discretionary rewards as a result, I think, or just changing up or replacing their entire pay structures. Rethinking metrics for any boards, the search for an effective pay metric in the current environment may be the equivalent of the proverbial snipe hunt. I think plans that depend on absolute earnings per share or other earnings-based metrics may be literally inoperable now. About where does a board go in search of replacement? As with goals, many compensation committees may end up choosing to go with more discretion, which could open themselves up to criticism both from sort of market commentators and also potentially from investors in future seasons. And then finally, repricing underwater options. This is something that used to be almost a knee-jerk activity whenever the market went down. But shareholder approval requirements for option exchanges make those knee-jerk repricing events much more difficult and less likely today than they were back in the heyday of option usage. Shareholders still may see some of them, but they're more likely to be a spate of retention and inducement grants aimed at high-value individuals who are holding those underwater options at this point in time.
Gotcha. Yeah, I guess, I'm also curious, Pat, with respect to the trend, the uptick in terms of both interest and focus on ESG. I've been, seeing in different places that the pandemic will accelerate that trend, hearing otherwise, and, from other corners. What is your take on what the pandemic means for the ESG movement?
Yeah, right now I'd have to say that ESG is probably TBD, that is to be determined. I think clearly for investors and directors who have bought into an ESG focus as a means of making their companies more sustainable and resilient, nothing should really change. But for those who weakly or cynically embraced ESG to be fashionable, their lack of commitment will probably be obvious pretty soon. I think one clear result stemming from the pandemic will be the increased focus on human capital management in the boardroom. The current crisis has taken a toll on rank-and-file employees. Layoffs, furloughs, and other reductions in pay hours and benefits will leave lasting scars on many workers and their family. For healthcare workers, those in other frontline positions at grocery stores, pharmacies, and in the transportation and delivery industries, that the health and safety concerns will become make or break issues for boards in the near and in the long term. When demand resurfaces in the labor force, employees are going to be able to pick and choose, frankly, whether they return to their old employers or look for new ones. And examining how senior management and boards acted before and during the crisis with respect to their employees will play a big role in those decisions.
Yeah, all good points. Certainly interesting to see how that plays out. One other thing too, Pat, following the 2008-2009 financial crisis, we saw this sort of movement towards stewardship and greater engagement between boards and shareholders. And so I'm wondering, in your estimation, what the current pandemic crisis, may hold for the uptick in engagement that we've seen over recent years.
Yeah, I'm hoping that it doesn't go down, but I'm fearful that we'll see some weakening of the lines of communication. I think I had mentioned earlier the tendency of boards to become more insular in the face of crises. I think this circle tightening really shouldn't come at the expense of engagement, but I think unfortunately it will for a period of time. The current market conditions make timely disclosures and transparency more important today than, frankly, in past crises. I think the SEC has been out in front of these issues in recent weeks. I think calling for companies to really bolster the quality and the quantity of forward-looking disclosures that they're providing. Truly, executive directors and investors are quite interdependent today, but information vacuums will exacerbate existing uncertainty and promote fear in the marketplace, which is really the enemy right now. Communications are especially important on issues such as capital raising and payouts to shareholders via dividends and share repurchases. Notably, the stock markets have waived some of their existing shareholder approval requirements on an emergency basis related to private placements of stock. And so in those cases, a board should look to raise, if they're looking to raise capital in those ways, they should clearly be touching base with investors now.
Again, all good points, Pat. Before I let you go, I just have one final question for you, and that is what you see as the long-term implications of the pandemic really for new legislation or new regulation. What are your thoughts in that regard? Yeah,
going back to your first question, I think poor governance wasn't a root cause of the current market meltdown, so the likelihood of a follow-up to Sarbanes-Oxley or Dodd-Frank looks pretty remote in the U.S. market right now. I think the odds could rise, however, if we start seeing bad behavior by market participants, especially amidst the final stages of a presidential campaign here in the U.S. I think aggressive moves by activist investors or even more M&A by mainstream corporate or private equity players looking to buy up shares on the cheap could get Congress into the game in a pretty significant way. Likewise, the big payouts of scarce corporate cash for stock buybacks or dividends in the current environment could lead to limits, notably the federal bailout loans that come with some pretty heavy strings attached, no buybacks or dividends for 1 year after the loan is no longer outstanding. And notably, likely Democrat presidential nominee Joe Biden has gone even further, calling on every CEO in America to commit to no stock buybacks for 1 year. So we're clearly going to see a lot of pressure on companies if they're looking to return capital to investors to explain why they're doing so, given the timing. And CEO pay is also likely to become a bigger issue. Notably, CEO pay and severance at companies accepting federal loans is also limited, and those limits are even more significant in some other markets, including Europe, I think. And so these are all the sort of flashpoints that could, turn the crisis into new calls for legislation, both here in the U.S. and abroad.
Well, we will certainly be watching as over the coming weeks and months. And Pat, as promised, that was my last question. And let me just thank you for the insight. Always great to have you on. Look forward to having you on a future podcast. And to our listeners, please do tune in. We will be covering special situations research on our next podcast, which will be later in April. With that, I thank you again, Pat, and take care.
Great, thanks.